Hello, I'm here with Andrew Haldane, the Chief Economist at the Bank of England. Andy, morning. Thanks for being with me today.
Thank you, Marshall. Great to see you.
You too. I saw you about 6 months ago at Trento. You made an excellent speech about too big to fail. Not really an optimistic one, perhaps, suggesting that we have quite a long time frame before things get sorted out. I'm wondering if your views have evolved since then, or if you would like to elaborate for us today on this.
Well, we're still on the same path.
Yep.
I'm not sure anything has fundamentally altered in the reform package that's being worked through by the international community. I reckon that reform package is midstream, maybe a little bit more than halfway through. It includes some of the stuff we all know about: extra capital, lower leverage in the banking system, which is a good thing.
If maybe not enough, 3 to 5% maybe might not be quite enough for that.
So we might come back to how much is enough.
Yes, that's right.
But essentially we're moving the system, I reckon, from one where the biggest banks were 30, 40 times leveraged to one where they're 20 times leveraged. Now, does 20 feel safe? We might come back to that. But it's much better than the situation we were in ex ante. That's one element. The second element, I think, which is at an earlier stage but working its way through, is trying to get ourselves into a position such that if a big bank does go down, we have some means of winding them down or resuscitating them in a way that doesn't cripple a wider economy. That might help, you see, because if we got to a regime that could credibly swap debt into equity, that would help top up leverage in a situation of stress. It would help improve the sustainability of banks if they got into difficulty.
On that point, though, ideally you'd have to be proactive to some extent. So you would have to have some early warning signals suggesting, for example, that there is a bank that's in trouble and that you start implementing this before we get to the bankruptcy stage, or so we force them to convert a certain amount of debt into equity. Now, of course, there is the argument that the minute you do that, you start, it's akin to screaming a fire in a crowded theater, and that you actually exacerbate the instability. So how do you deal with that problem?
So that problem is real. I think one way of thinking about dealing with that is to have those prompt corrective action measures, if you like, operate, one, fairly early on, and two, hardwired in contractually, so that investors looking in aren't surprised when these conversions from debt into equity take place. It doesn't spook the markets that they're happening, because those conversions are contractually pre-committed to. So if you like, these are these so-called COCOs, contingent convertible securities, but happening, as you say, Marshall, early enough in the distress process that you aren't at death's door. It's a preemptive topping up of equity, if you like, before the real damage sets in.
There was some talk, well, there's often been talk that at some stage we've got to get back to quote-unquote normality, and that the central banks have got to extricate themselves from this position where they are, if you like, the counterparty of last resort. Yeah. About 50 years ago, Minsky suggested that, in fact, the Fed should never leave the discount window, should always make use of it, and should incorporate that as a permanent feature, because he felt that it would act as an early warning signal. So that all of a sudden, if you started having some junkier collateral being posted with them, that would be, the lights would start flashing yellow. And maybe for the same reason, we don't actually want the central bank to extricate itself from whether it's the shadow banking system, which is coming out of the shadows, or being the counterparty of last resort, precisely because it will give you that early warning signal and prevent you and enable you to take prompt corrective action before it becomes disastrous.
This is right. I think this is right. So we see it with national central banks when lending to national banking systems. We also see it with the IMF when lending to countries. And in both cases, there is sometimes some stigma attached to the act of borrowing. be it from a national central bank or be it from the IMF. And that puts off the day of reckoning. It often leads banks or countries to leave it to the last minute before coming to the central bank or coming to the IMF for help, by which stage a bad situation
is catastrophic.
Yeah. It's catastrophic. So I think we as central banks and we as the international community, as shareholders in the IMF, should be looking over time progressively to remove that stigma so that the act of seeking liquidity insurance from a central bank, from an IMF, isn't seen as an act of desperation, isn't seen as a prelude to cataclysmic collapse. It's just seen as an orderly way of doing business to help ride out temporary squalls in liquidity, the like of which we see increasingly, I think, across financial markets.
And as you say, and in liquidity, really, the spectrum from liquidity to solvency, I mean, it is one of really the same continuum. And at one point, an adverse liquidity condition can become an insolvency situation, and vice versa, depending on the actions of the central bank.
Quite so, and that is a tricky balance. It's always been a tricky balance. There is a huge grey zone between the two. But one thing you can say is that, you know, for situations that look more obviously temporary, then bridging finance from the public sector, from a central bank, from an IMF, can stop you getting ever deeper into the grey zone. And historically, perhaps borrowers have left it too far into the grey zone before seeking that insurance. We, as central banks, we as shareholders in the IMF, should try and turn that tide a bit. I think the crisis has changed things quite a lot on that, Marshall, actually. Certainly at the Bank of England, at the ECB, the BOJ and the Fed, we have become much more liberal in our liquidity provision, the terms on which we offer it, the collateral against which we are willing to take.
We lend freely, perhaps, but we don't invoke the other part of Bagehot's law. In other words, I'm not sure we're doing it at punitive rates, and I'm not sure that's necessarily the right thing to be doing.
No, but we do try and secure, a second element of Bagehot is in there,
yes,
which is securing against good collateral, which sometimes may mean taking, if the collateral isn't great, taking a sufficiently large haircut on that collateral to keep your balance sheet safe. So we've seen a mini revolution, I would say, in how central banks through the crisis have gone about their liquidity provision, returning us to something more Bagehotian in its orientation, but upgraded for the 21st century.
Now, I was chatting to Ed Kane the other day, and Ed was suggesting that because you've still got very, very large multinational banks, the so-called systemically dangerous institutions, it's very hard to deal with it at the national level. And he was suggesting, for example, that much of the business that is currently being done in the US will simply migrate to London. They'll move to the clearinghouses, but ultimately the Fed's still going to be on the hook and ultimately the US taxpayer, because they are dollar claims, dollar liabilities, and he didn't see any way around that. I'm just wondering if there any possibility of regulating at the national level, or does this have to be a global international solution in terms of regulation?
Well, I think we're doing all we can to put in place a genuinely international regime for the supervision, and which is the kind of good times, and for the resolution, that is the bad times, of these global, we tend to call them systemically important rather than systemically dangerous, but nonetheless, the point's the same, institutions. I think we're seeing bits of progress on that. Certainly, the notion that individual regulators need a cross-border coordinated plan for a failing cross-border firm, that's now in the bloodstream. We don't yet fully have those plans, but they are being worked upon. That's the sort of bad
the dollar swap facilities, for example, seems to be a classic illustration of that. Although I note that the Fed has taken tremendous political heat in the U.S. For adopting these dollar swaps, for example, to help provide dollar liquidity in the Eurozone, as an example.
Yeah. Well, that has been one of the many transformations, many revolutions, I would say. which is, at the end of last year, November 2013, I think it was, there was an agreement, little commented on actually, very little commented on, among the G6 central banks.
That would be the Fed, Bank of Canada, Bank of England, Bank of Japan, ECB,
and the Swiss National Bank.
Swiss National Bank.
The sixth. That they would make available to each other swap lines. This is, Fed to Bank of England would be dollars for sterling or vice versa, on a permanent basis. In prospectively unlimited amounts. Okay, permanent and unlimited were the words that we used. Now, of course, the decisions to extend those swaps are still at the discretion of the individual central bank. So there's no guarantee, say if you're the Bank of England, that you'll get a permanent unlimited line from the Fed if you so require. But nonetheless, the framework agreement is there, and I think that was very potent.
I was surprised that it didn't get more commentary, actually.
I think it should be discussed much more widely, because here is the start, the foundation stone, for something that could be actually very important for dealing with some of these cross-border liquidity problems.
Well, there you effectively do entrench the central bank, if you like, as counterparty of the last resort, actually, in that kind of, which I think, in some respects, reflects the new type of banking financial system we have, which is largely securitized. It's not, I mean, the classic form of credit intermediation of banks extending loans to individual companies, that's gone. I mean, it's not gone, but it's in the US, that's only 25% of all credit, and I think it's probably similar in the UK right now. Securitization is advanced much more further along.
Although less far in the UK and certainly elsewhere in Europe than the US. But just returning to my point about how the cross-border scene is changing, one reason I think these swap lines are important is because when it came to coordinating supervisory actions for cross-border firms, we had these colleges for coordinating, but to be honest, Marshall, they didn't really do very much coordinating. They didn't do very much information sharing. Because if you were the home supervisor, what were the incentives to open yourself up to being second guessed or even in providing information? The swap lines, they changed that. Let's say you're the UK and you have a bank on your doorstep operating in London that is very dollar dependent, okay? That may mean if that bank were to get into distress, it may require a dollar line, and that can only come from the Fed. But if it's to come from the Fed are going to want some confidence, some assurance that this bank is solvent, that this is a line worth extending. And to get that assurance, then the colleges will need to work. There will need to be information sharing in peacetime as well as in wartime. There will need to be coordinated decision making. If you like, the swap is the quid pro quo for making the college work in peacetime.
And you have to ensure that the bank itself that's concerned will be forthcoming with the information. As we saw, for example, with the London whale episode, that part of the problem was we didn't get full disclosure. And in fact, there seems to have been an active attempt by the bank concerned to impede the flow of information to the regulator.
Well, there's definitely a big black box problem, how to say that, for banking. With the balance sheets the size they are, often several trillions of dollars, and of the complexity they are, and few inroads have been made either into size or into the complexity of those balance sheets since the crisis, unfortunately. Given that, there are these dark parts, these black holes, that progressively we need to start peering into and understanding much better. We are not there yet.
And that gets into the whole range again of regulation. And you mentioned before about the capital ratios what I mean, without trying to put you down to a firm figure, is 5% enough? What would you? I mean, some people would suggest that what the Swiss have, which is closer to 20%, is actually a much more sensible ratio to deal with a true systemic type of crisis.
Well, I mean, let's go through the gears on this. So we will, for the first time ever, have an internationally agreed leverage ratio. It's at 3%, equity over assets 3%. That's better than nothing. It's the first time we've had such a regime. In the US, just this week, we've had further progress still. So the US authorities have said that in future, the largest banks in the US will be required to meet a leverage ratio of 5%, and their deposit-taking subsidiaries leverage ratio of 6%, which would be double the international standard. I think now you're talking.
And I think the Bank of England is moving in that direction as well. Certainly that seemed to be the Vickery Commission recommendation seemed to move in that direction.
So the Vickers Commission proposed that if you like, the deposit-taking bit of the bank, so-called ring-fenced bank, ought to hold at least 4% of equity relative to assets. This is getting there. Is it the levels, to your question, at which we would sleep comfortably in our beds at night? I think that for me is more debatable. If you look at how volatile banks' assets have been historically, would a cushion of 2, 3, 4, 5% be adequate to cushion that volatility? Well, not completely.
Well, I think the other issue is this. Capital requirements, capital buffers, in a sense, are there as an insurance policy to deal with a pre-existing problem. And there is an argument to say that the liability side of the bank's balance sheet is not the right place to achieve regulation, that you do it on the asset side of the balance sheet. And that what you really should be doing is restricting the range of activities which give rise to the need for those high capital buffers in the first place. But we don't seem to be anywhere close to thinking in those terms right now.
Well, what we haven't done, what hasn't happened so far, is the placing of explicit quantitative restrictions on the asset side of the balance sheet, sort of size caps and the like. Nor have we gone the route of full structural separation of different types of activities, Glass-Steagall type.
Which may not be relevant given that we are no longer in a Glass-Steagall type of world, given the amount of securitization that actually occurs. There is an argument that you can't go back to a simple banking model when you've opened Pandora's box, so to speak, in this wonderful world of securitization. For all the pluses you might have in terms of the democratization of credit, you still have a real problem about simplifying the structure once you've introduced this level of complexity.
Well, I would certainly say that in that world of greater amounts of capital market financing of the wider economy, which I think is a positive for the reasons you say, Marshall. We don't want to be overly dependent, over-reliant on the banking system. We want a second cylinder for financing of companies and financing indeed of households. So given that, there is no longer a clean, bright line between, if you like, commercial and investment banking. Nonetheless, proposals like Volcker, proposals like Vickers, proposals in continental Europe by a group chaired by Erkki Liikanen do go somewhat in that direction. They do say there are some activities that we do not want cross-contaminating the balance sheet, the deposit-taking balance sheet for sure, of an entity. And that is the thrust of Volcker, Vickers, and Liikanen. Not usually via forcible separation, although Volcker and parts of Liikanen have elements of that. Sometimes just by putting legal gateways between the different parts of the business to guard against this cross-contamination. That could be financial contamination, or it could be cultural contamination. Because we all know the business of proprietary trading generates different behaviors than the business of taking deposits. 'Twas ever thus. Commingling those cultures does risk cultural contamination as well as financial contamination. And that, for me, was some of the problems we found ourselves in pre-crisis.
And the challenge, of course, is ring fencing the respective sandboxes and making sure they don't contaminate one another, as you say.
Yeah.
So we're on the right road. It sounds like we've still got a fair ways to go, but at least we are heading in the right direction. There's a lot more I could ask you, but we've run out of time. But Andy, thanks again. It's always great to speak to you, and I hope I'll get a chance to follow up with you again very soon.
And you, Marshall. Thank you.